What's up, you guys? So in this video, I'm going to be going over my first installment of the new series I'm creating, Investing 101, where I plan on taking people through not knowing anything about investing and what to do with their money to providing them with all the information that I've learned over the past 5 years on how I've grown my money over time and with what business ventures have succeeded and have not succeeded with for me, and what I wish I knew before I started any of those, and what I think will provide a lot of insight and allow you to get that jump start on your financial journey. If you guys are new to my channel, my name is Dan, and this is Millennial Investing. My two passions are in technology and finances, so if you're interested in either one of those subjects, make sure to stick around, hit the subscribe button, and let's jump into the video. So, investing is very unique and personal for every single person involved. Investing is never going to be the same for your best friend as it is for you, because everybody has different financial goals, different financial situations, different mentalities, everything. You're not the same person, so your financial advice should not be given the same for them. So my goal with this is to educate you to open up those doors so you can make the decisions for yourself on what path you want to take. So the first thing to think about is, what situation are you in life? Now, you could be 40 and you could have not saved a lot of money, or you have some money in your 401k, but you're afraid that that's not going to be able to cover you when you retire, or maybe you want to retire early and you want to just increase your wealth. How can you do that? You could be, my age. You could be 21, 18, 21, just starting out in college, just graduating college, taking your first steps out there in the corporate world, and you don't want to deal with a 9-to-5 life, and you want to escape the rat race, and you want to build wealth, and how exactly you can do that. So the main thing to think about is that you need to make sure that you have a strong base before you ever invest. When you invest, you allow your money to grow over time for you, assuming it's a proper investment and assuming the investment goes in your way. Now, no investment is guaranteed. Every investment has some level of risk, and if you don't have a base for you to take that, whether it be a high risk or a small risk, you are going to become very emotional, and you could potentially lose all of that money at the worst possible time, and it will devastate you financially. So you really need to make sure that you have a sturdy base. If you look at people like Dave Ramsey, they recommend having 3 to 6 months of your expenses in a savings account, pass out of the way, and you want to pay down your debt first. So if you're like me and you're a college student, you're probably going to have some debt. It could be a few grand, or it could be, $100,000, depending on where you are and where you went to school and how much aid you got. But you need to make sure that you focus on getting down debt and creating that cushion of an emergency fund before you even think about investing. Because at the end of the day, if you have debt, you can think about debt as a negative investment. While your money can compound in an investment and make you a lot of money over time, the debt is going to continuously compound and lose you an immense amount of money over the long run. So you really need to make sure that you need to cut that down and think about that. Say if you have debt that is at a 20% interest rate, every time that you pay off any amount of that debt, you can think about that you just got 20% returns in the stock market, which if you can do that continuously, good for you. Not many people can. And so really focus on getting rid of all that debt and putting you in a sturdy base, so that way you have the ability to take the risks that will allow you to become financially successful and financially free. Now, the next step is, what is your monetary goal? Like, you need to figure out, are you planning on, investing and having, Lamborghinis and yachts and big things? I am not one of those people, so my insight to what that means is going to be a little bit different from, a multimillionaire. But, for people that are looking at, I'm going to be working a full-time job, I just want to make sure that for retirement, I'm set and I don't have to worry about it. Or maybe I want to start a side hustle and I want to just make sure that I can grow a little bit of extra money, so that way I have more wiggle room and I don't have to worry about my bills. And those are the two big differences between whether you want to be safe or you want to live large on your investment journey, and they're going to have very different ways of approaching investing. So if you're someone that is looking for, the really rich lifestyle, odds are stocks, commodities, and things like that aren't going to be your biggest forte. You need to mainly focus on investing on real estate, businesses, yourself, and maybe possibly becoming a venture capitalist, because your biggest issue is that you need to increase your income. Investments are great, and the stock market's great for scaling all of the wealth that you're accumulating from your income. But if you plan on becoming a really rich person, you need to make sure that your income is at a significantly high level before you even think about, scaling up your leftovers. Because think about it. If you're making 60 grand a year, you can't go from 60 grand a year to getting great returns in the stock market to becoming a multimillionaire, by the time you're 30. Like that's like if you're starting out at 20 and you expect to become a millionaire in 10 years, you're not going to gain that from only having a few $1,000s each year to invest in the stock market. You could have amazing returns, and that's just not going to happen. If you're someone that's only making $60,000 a year and you can only afford to invest a few $1,000s, you're not going to be hitting that multimillionaire bracket anytime soon. However, if you're someone that is making $60,000 a year and you want to make sure that when you hit retirement, you will have a couple of $1 million in your savings account or in your retirement account or in your brokerage account, so that way you can live comfortably the second you retire and never have to worry about anything, you can kind of do that in a very passive way, and it doesn't require a lot of work up front. But again, if you plan on getting out of, like, say, the rat race at the $60,000 a year and you plan on hitting that multi-million, salary income, you really need to buckle down, and you're going to need to start a business, which is the #1 way to accumulate wealth, or you're going to need to become a venture capitalist and an investor that isn't just going on the New York Stock Exchange and putting money in an already giant corporation that isn't going to grow feasibly that much over this period of time. You need to find something that is going to give you 5, 10x your returns in 1 to 3 years multiple times and get good at it, than someone that just plans on, having a comfortable retirement. So you really need to make sure what your goal is before you even think about investing. Because if your goal is to, become a multimillionaire and you start putting money into the S&P 500 every month with dollar cost averaging, your money should grow over the long run, but it's not going to give you those quick and fast returns that you were expecting. So don't go and look around, YouTube or books or anything to invest in the stocks if you plan on becoming a multimillionaire through it, because that is just not the case normally. There are exceptions with people that are traders, but for the average person, you are not going to become a multimillionaire in a short period of time through the stock market. That is not how it works. So next is your work ethic. You need to be able to decide and know for yourself, how much time am I actually going to be dedicating to my finances? And that is a number that varies a lot depending on who you ask. I know people that are, they want to invest, they know that they should, but they don't want to give any more than like an hour to a month to actually looking at their investment portfolio and dealing with it. They want to, cast it aside, know that it will be there in the future, and live that kind of like low stress relationship with it, and just not deal with finances on the day-to-day. If you're someone like me and investing is like one of the biggest hobbies you have in your life, and you're willing to dedicate 40-60% returns, you have a very different option of where you should look to invest than the person that wants a really passive way. Biggest instance is probably going to be whether you focus on investing in ETFs or if you focus on investing in individual stocks with your money, assuming you invest through stocks. And that's where the majority of this topic, this video is going to be leaned towards. So if you're someone that, you want to just build wealth slowly over time, put it in the back of your mind, dollar cost average into stuff, and, know that when you go to retire, you're going to have a multi-million-dollar account, and not even think about it up until then, you're going to want to go blue chip and ETF route, so that way you're only looking at great big companies that are they're pretty stable, they're not worried about their finances, and they're going to be paying you money over time. They're going to grow at a slow but steady rate. Or index funds that are going to give you a little bit of everything and instantly diversify you across everything possibly out there, to know that as long as the overall world economy goes up, you gain money. Again, if you're someone like me though, that doesn't really cut it. There's a lot of more risk, dealing with someone that wants to, have investing be a huge part of their life, and they want to dedicate a lot of time to investing, because generally with individual stock picking, an average investor ends up losing to the passive approach, which is just, putting money in the index blindly over time and then just riding out the returns. I think there was a report from Barron's that kind of showed the newest estimate for the last 10 years or so of returns. The S&P did, a little bit over 10% returns on annual of the past 10 years, while the individual stock picker had about 4%. And that's generally due because people that are, individual stock pickers generally get very emotional. They either start picking stocks when they don't fully know what's going on and they drop and they get freaked out and they sell, or, they don't have thick skin. And then when you invest in say an industry like tech and you have massive movements, whether it be up or down, and you just immediately sell based off of the price movement and not the actual company, A lot of the times people that don't have a good grasp on why they're investing and how exactly they want to be investing will pull their money out at the worst possible time and, just create a lot more stress for them when they could have had better returns with no stress at all. Marginally no stress at all. So that's something that you really need to think, and you really need to know that if you're able to buckle down and, tighten the belt and really know that you are going to be dedicated and you're going to create your investing principles and follow them to the T no matter what, then you can do the individual investing route. But if you're not and you just want to be passive about it and you just want to say like, hey, let my money grow, let me deal with that later, I can give it to a financial advisor, or I can just walk into this later on and just check on it quickly on my phone and then forget about it. You can definitely go the passive way. And I'll make a whole video about exactly what are the risks and rate of returns with both of those investments and who I think should or shouldn't be investing in index funds or individual stocks based off of a couple of other things. And so the last thing that I want to touch upon that is probably the most important, and it kind of relates to why the average investor gets a 4% return and the market gets a 8 to 10% return, and that is because of your psychology and how aware you are about your emotions. Now, you will hear this time and time again that the stock market is focused around two emotions, fear and greed. Now, people generally run into issues when they let one of those two emotions be so much more prevalent than the other one. So if you look at people that, they're searching for, like if you go to the dot-com bubble and they're searching for massive gains, there were people that were expecting, 1,000% returns from their money, just from throwing it in some new emerging tech company because that industry was booming and they wanted those capital gains. They didn't care about the risk of the company. They didn't bother doing their homework about the company. They did no research. They did no insight. They just decided to throw their money in there because they saw all of their friends making money and they expected to have the same return. And because of that greed of them just instantly wanting money with no work, so many people lost, 70+% of their money when the dot-com bubble burst. And odds are, if you went in from greed, you probably sold because of fear when everything didn't go your way, because you didn't have the confidence in your investments. The other, flip side to that is that you could be someone that's driven totally by fear. And so these are people that have been, since, 2008 have been out of the market because they just assume that, okay, we found out that debt's bad and we found out that banks are corrupt and the government's just going to keep bailing them out and our debt ceiling is going higher and higher and higher and we keep smashing through it. And all of this is just held together by, strings and duct tape. I'm out. I'm just going to wait for everything to crash and then maybe I'll put my money in. And, these people, while they could be right, they've missed out on some of the best years in the stock market's history. Even if they just invested in the S&P 500, they would have more than tripled their money from the time of, if they immediately bought in at the trough of the Great Recession. So, as Peter Lynch once said, unless you are a poet, do not bank on pessimism with your money because, odds are America and the rest of the world economy is going to go up over time. And if you're being extremely pessimistic about, what's going to happen or everything that could possibly go wrong is going to go wrong, all you're going to do is you're going to miss out on gains because yes, statistically 8 to 10 years, stock market will drop in half, because of a recession. But in between that, you're going to have years where you have great returns. And then if you buy in during that, you have immense returns once the market recovers. And a little thing to keep in mind, and kind of the way that Warren Buffett sheds light on the people that are extremely fearful of the stock market, is we have never once not recovered from any correction that we've had. Sometimes it's not immediate, sometimes it's faster than others, sometimes it could even take a decade. But the market has always gone up over time. And if you think about it, if you take a step back and just think about what your money would be doing on the S&P 500 timeline, if the market drops, say if the market's at 100 and the market drops to 50, if you bought at 100 right at the top of the market, you just lost $50, which just sucks. And people might be like, oh, this is going to go to zero, I need to sell out. Or there are people that are thinking okay, well, the market's always recovered, so I can potentially at some point see a return from going from $50 back to up to $100 at least. And now if you think about that in percentage-wise, if you start at 100 and you go down 50, you lose 50%. If you start at 50 and you buy in once it starts going down, and it recovers to at least 100 again, you looked at a 100% return. And that's why big investors, especially like Warren Buffett, make so much money. It's not because when the market's going up, it just goes up so fast that people just make a lot of money. It's because when the market tanks and people start buying at the bottom of it, once it recovers, you have, multi 100% returns just when things get back to normal. Everybody's freaking out. No one wants to have anything to do with stocks. So you just buy shares of companies for pennies on the dollar, where they're actual assets of what they own. They could own cash. They could have $30 billion in cash, but their stock value is only worth like $10 billion. You're pretty much getting a free, $20 billion, assuming you bought that company. So you really need to keep that in mind and have that perspective in the long run with any investment whatsoever. You need to know that over time, stocks go up, but they also do come down. And you can't let either one of those motions, whether it be fear or greed, drive your decisions. You need to take a step back and look at things from a long-term perspective and know exactly what you're in the market for, why you're here, how long are you going to be here for, and then what do you see happening, knowing that the market goes up and the market goes down. So hope you guys kind of enjoyed that. I thought that was kind of, a really big, broad spectrum on multiple different facets of what it's like to, think about investing. But those are really the main points that I think every person, whether they're young or old, really needs to think about before they do anything with investing. In the videos to come, I'll go really deep into, how to evaluate a company, how to read balance sheets, how to read cash flow statements, what's the difference between a couple industries, and what's the difference between cyclical stocks and non-cyclical stocks, and what type of investor are you, and based off of your personality and how much risk you can take, what I would do if I was in your situation, and what I've done in my situation, and what has given me the highest and lowest returns with whatever investment strategy I've used. And eventually, I'm going to be going over what my personal portfolio is, what simulated portfolios I've created and how they've done over time, and what was the idea behind those portfolios, and whether or not that would be a good idea for you to think about applying to your finances, assuming you agree with my philosophy as to why I picked those stocks. So there's going to be a lot more videos in this series, and I really hope you guys can get some useful information out of it. Again, my name is Dan, and I hope you enjoyed this content. Make sure to leave a comment down in the section below if you want to ask me any questions, if you want me to do any particular stock or company that you want me to give a thorough breakdown on. And as always, have a great day. Peace.